Hello everyone. Today we're going to talk about how do you prepare yourself to get qualified for a loan so you buy your first home. My name is Simon. If you're new to my channel, make sure you subscribe, and as always, give us a thumbs up. It will help our channel grow. How do you prepare yourself buying a home? Most of the time, there's a few things we don't really pay attention and we don't plan long enough because we don't know the detail. Today I wanted to bring this to you so at least you will be aware, and I'll share with you some websites and some tools that will help you develop a good strategy as you're thinking about buying a home. The first thing we're going to talk about is your credit score. Credit score had to be really in good stand, and the higher the number, the better loan you get approved for. A good score is around 670 to 739. The credit score range from 300 to 850. Most of the time, if you don't have no credit, your credit score might be in low 600s or even below 600. The government loans like FHA might require you only 580 or 620. But any of the conventional loans, which is through the bank, the money will be loaned to you from the bank or a lender. Most of the time they require you a little bit higher. If you are in 700s, that will be the best and lower interest rate, so you benefit all the way around. So the first thing is you pull your credit from Credit Karma or any other free websites, or even you can subscribe to the credit monitoring services. So I'm going to put this website link under description so you can go on that website and read through it. It will explain what is a good score and how you can manage your credit score, what you need to develop, and what you need to do. It will give you the insight, a little bit of detailed information. I want you to pay attention on your credit score. That's the first thing when you think about buying a house. If you are someone who doesn't have no credit history, you can work with your bank to start setting up a secured line of credit, so that way you will start building your credit. You can check with your bank how you can do that. That will be the beginning. Or you can start applying for credit card and start paying on time and make sure you use it responsibly, so that way you start building your credit. The second thing we're going to talk about is income. If you are an employee and you have a job, if you've been at your job for at least a year or two and your income is consistent, that would be the best thing. And also, if you are self-employed, you're going to need at least 2 years or more of your tax return to show a consistent income. So if you are an employee and you've been in one job, and if you're thinking about switching a job, make sure it's a similar industry. Most of the time the banks or the lenders would like to see that you stay in one job, so that way it will be consistent. So as they giving you a loan, it will be easier for them to figure out if you can afford the house you're going to be buying. So on the income side, make sure you have consistency, and also lenders, they will calculate your debt ratio to 45%. I'm going to explain what debt ratio means. If your income, let's say your income is $3,000 per month, and once you take off 45% of that, if your income is $3,000 net income per month, and your 45% of that is $1,350. So out of that, usually the lender will deduct whatever expenses you have, monthly continuous expenses, which is like, for example, if you have a car payment or any other credit card payment, or if you have like a student loan or something that goes out monthly, that expense is going to be figured on qualifying you how much you can afford. So let's give out an example of you have a car loan and your monthly payment is for $200, and you have a credit card or some other miscellaneous payment of $100, and you have, let's say, student loan or any other stuff for $150. Now you have an expense of $450 monthly. This is without counting your other expenses, your living expense and your insurance, phone, and all that stuff, because when they figure it out and take out 45%, the other 55% they are figuring out that you're going to be using for the other side of your expenses. So with that, now you will have $900 left. With that $900, I made a little bit of a calculation here to kind of give you how much will you be able to afford with that amount. So with $900, if you put down 5% of a down payment, and with the interest rate of 4.5, you can afford to buy a house worth of $150,000. This is a simple rule of thumb the bank uses to figure out about how much can you afford based on your monthly income. This gives you a little bit of an idea how it's calculated. If you have 10% down payment and you put down $15,000, because the payments I'm going to show you right here is the column says monthly payment $722 for the first one, and also there is a thing called private mortgage insurance. Whenever you buy a house, a property, and it has you didn't put down 20% or more on the mortgage down payment, you'll be required to pay that insurance. That private mortgage insurance, what that is that the lender who loaned you the money, they will buy an insurance against that loan, so that way for some reason if it gets defaulted or if you didn't pay them, they have an insurance to cover on their loss. So that's why they make you pay. But the minute you have 20% down or more than 20% down, that private mortgage insurance goes away. And also on your situation, if you couldn't afford to put down that 20% down and you bought the house, in a few years, if you believe that the house you bought is a good deal and the value is going to go up, in a couple of years you can reevaluate, reappraise the house and communicate the lender and say, okay, my house, I purchased it for 100, but now it's worth 120. I know I put down only 5,000, which I owe still $90,000. But since the house is worth now 120, the equity on that house should put you above 20% of equity, which will eliminate the private mortgage insurance payment. So you can get rid of that insurance payment once you start paying on your house and the value goes up on the house by communicating the bank. But as get going from the beginning, if you can put down 20%, one, it will drop your payments a little bit less. Two, it will help you from not paying a private mortgage insurance, which on this example, if you look at it, it shows if you put down 5%, there's $119 a month for private mortgage insurance. On top of this payments I calculated, there's also an additional of hazard insurance, which is a property insurance, and also your property tax. The property tax and insurance is not included on this number, so just keep that in mind too. And based on which area you live and what city you live, the property rate is a little bit different in every community. They have in every city they have a different rate, so make sure you figure out how much your property tax can be per 100,000, and also figure out how much your property insurance will be for your area. So always remember 45% of your net income. Play with this number, and I'll share with you another link on the description. This tool will be a great mortgage calculator So this will give you a pretty good insight. So we already talked about the fourth thing that will help you. Now is the number one is your credit score. You need to work on that. Number two is your income. You need to figure out if you're going to stay one job for a couple of years at least, so that way the process will be much easier. If you are an employee, if you're a business owner, make sure you have at least 2 years of solid income so you can show the net income and work with your bank. Number three is make sure you calculate your debt ratio and unnecessary expenses, which is staying on your credit report. Maybe get rid of it if you don't need to show it on your credit report as you're buying a house. If you have, let's say, small balance on a credit card, try to pay it off so that way it won't keep on showing up as you're applying, because that payment is going to show as a negative reason for you not to be qualified for a higher number. So make sure you clear that up. Number four is your down payment. If you can put down 20%, it will help you eliminate the private mortgage insurance, so that way you don't have to pay that additional $100, $200 unnecessary expense unless you have to. So if you can avoid the private mortgage insurance, that would be the best thing, which means you need to put down a higher number of money. So you need to start saving the cash as you're thinking about buying that house. And the last thing I want you to be aware is that as you're buying a house, yes, you can call the listing agent of the house you are interested, so you can work with them, but the best scenario for you is to have a good real estate agent or someone who can help you as a team, who can work for you, find a good location, a good house as soon as it comes out to the market, so they can be on point to start looking for the house you are looking for. And that will be having a good team really can help you a lot on finding a right home. And the next thing is when you talking to a lenders or the bank about your loan, just don't stay by talking to one bank. Try to talk to a couple of them, 2, 3, 4, 5 of them, so you will see who can work best with you, because based on the loan officer you're working with, your process can be a lot smoother or can be more complicated. So make sure you find the right person. Not every loan officer is talented or good at their job, so that makes a big difference too. So make sure you find the right person that fits good with you. So with that, hopefully this information helps you out at the end, so you will own your first home. Enjoy it. Take care. This is Simon again. Hopefully we'll see you on the next video. Make sure you subscribe and give us a thumbs up as always, because it helps our channel. Thank you for watching. Catch you on the next video.